All right, so let's see here. So this is a trust that, this is a slide that First Trust puts together. If you've been to any of our presentations over the past, can't see it, it did not change. Okay. We are, it says your screen sharing is paused. Okay.
There we go, resume share.
Resume share right here.
Yeah.
Okay.
Let's start the slideshow.
Yeah, let's try this. We're good? Okay, see, technical difficulty number one.
First slide, here we go.
First slide, we couldn't even get the first slide. So the presentations we've been doing over the years where we talk about market volatility. So this chart goes back to, I'm trying to look here, 1950. And so we go back to 1950, clearly the stock market is way higher than it was in 1950. That's 70 years of market returns. And the US economy's done really well and companies have grown in value. And so what this chart shows you is that there's a light blue line that kind of tracks the market along its route, and we were at all-time highs just a few weeks ago. What these dark bar charts show is normal intra-year volatility, which means as an investor, what kind of volatility should we expect any given year? And history has shown us that a normal amount of volatility is a 15% correction on average. So we've had years where the market's only sold off like 5%, which is a really low volatility year. And then we've had periods like 2008 where the market lost 50% of its value. But the average is 15. And so this is just as a reminder to show you that volatility is normal. Right now we're dealing with, if you listen to the radio, watch TV, we're watching cruise ships being quarantined. We're watching a lot of hysteria. And I think what's happening is this volatility that we've experienced over the last few weeks, I don't want to say it's normal, but the sell-off of 15% is actually quite normal if you look back at the last 70 years. It's just the severity of it. And one of the things that we always hear from clients, well, it feels different this time. And honestly, when you're living through it, we think that it feels like it's different. But we do believe it's going to pass. The timing is going to be really difficult for us to figure out.
It feels different while you're in it, but when we're able to actually look back and see, hindsight's 2020. When we look back, it's like, okay, I understand we recovered, but it takes some time and we go through some pain during that time. So it doesn't feel good, but we're able to kind of look back as we get through this and know that this is normal, and we'll be able to get through this as well.
Yeah, and the other thing that just as a reminder, when we look at our client base, we have those that are 20 years out from retirement. We have those that are on the verge of retiring, maybe 5 years or less. Those that are retired. So I think oftentimes we see a lot more stress around the market volatility with our clients who are retired because they're requiring a monthly withdrawal or a monthly paycheck. And because we know that this chart that we're looking at here that shows volatility, because we know this is part of investing, the reason why we set up an asset allocation plan where we have a certain amount of money in cash, a certain amount of money in bonds, and a certain amount of money in stock assets like US stocks, international stocks, as well as real estate, because we have, because we set up these allocations in that way, we set aside enough money in safe assets. And so as a reminder for all of our clients, we try to keep about 2 years worth of your spending needs in really safe assets, meaning cash or cash equivalents. Then we also try to kind of fill up another bucket, which is of bonds, which then takes it up to a full 7 years. And so we look at this volatility and say, you know what, we planned for this volatility, and that's why we set up the asset allocation in that way, so that we have 7 years of money in safe assets. And so for those of you who are younger, who are still building, we don't have a lot of safe assets. We've invested this with a longer term time frame. So just wanted to remind you, that's why we asset allocate. And we'll talk a little bit as we get a little deeper into our talk today about interest rates and what's been going on as of late. I don't know if you have anything else to add on this slide.
Also, the fixed income that we have, or the safe assets, is in addition to any cash that you guys have at home and your just normal bank accounts, right? So we're not really looking at those to help pay the bills. That's really your emergency account. And I know that usually we'll start every meeting with, how's cash flow? How much do you guys have in the bank? Do you guys need to receive additional money from your accounts to bring your bank accounts or your savings up to the target balance? So we always want to make sure that you guys are at or around that for kind of the rainy day, but then also we are planning, like John said, for the next 7 years of your spending for those that are retired, having that in safer assets or fixed income investments.
All right, so when we move on to the next slide, and depending on what you're all viewing this on, if it's on a phone, it might be hard to read. If you're on a larger monitor, it's probably fairly easy to read. Just a couple quick housekeeping. We'll make this presentation, the slide deck, available if you want to review it later, as well as we are recording this, and so it'll enable you to take a look at this at a later time if you want to look at the slides. But this basically kind of shows the markets going back to about 1980 and showing previous epidemics. I know there's been a lot out there, especially like on social media with previous issues with like the bird flu and Ebola and MERS and H1N1, which was the swine flu. And what this chart basically shows you is that even in all these periods of time, markets go through their normal course of volatility. And essentially in all cases, 12 months later, I think except for one, like on here, I'm sorry, I'm trying to read the screen. It looks like except for in 2 cases, the markets were higher 12 months later. And so we don't know what the future is. We don't know. We're not predicting that's going to be the case. But if we use some of these previous health-related scares as a guide, it shows us that when we fast forward and look back a year from now, we're going to say that might have just been a hiccup. Again, we don't know. I think that Jared was. I don't know if you're talking to a friend in the healthcare industry who was talking about how testing has been an issue. So
yeah,
we're still not sure how this is going to play out.
Yeah, I think, in full disclosure, it may get worse before it gets better in terms of the US numbers that are reporting. I think there was an article that mentioned that people that wanted to get tested actually couldn't get tested, or the people that got tested, there was issues with the test, right? So I think the numbers, unfortunately, might increase over the near term in the United States because some people that are actually just living with the virus at home apparently aren't really sick enough to go into the hospital to actually qualify as an infected individual. So as testing ramps up, as the ability for testing ramps up, I think we're going to start seeing some of those numbers go up. But we're starting to already see China numbers in terms of infected, and then the death rate there is starting to come down. So I think it can potentially get worse in the United States before it gets better, but places like China, that was obviously kind of the epicenter of the virus, is already starting to improve figure-wise.
Yeah, so the interesting dynamic with this is, we live in a society now where it's like information is immediate. It seems to us like there's a higher level of panic maybe than necessary. I mean, you guys are all seeing water shortages, toilet paper shortages. I mean, I think Amazon is still delivering. So I'm not sure why, Costco is running out of their stuff, but it's a little bit of the panic, and I think it kind of feeds on itself. And so part of our, job as financial advisors is to make sure, we're guiding you through this. We've got to stay out of the noise. We got to stay away from the hysteria. There are always reasons to be fearful. That's never going to go away. The question becomes, is this a permanent issue for our economy, or is this a temporary passing issue? And again, we don't know the future. From some of the medical stuff that we have read, and just to know, we're going to send out some resources that Raymond James actually put together, because we have industry experts around healthcare and oil markets and different things. We're going to share that with you as part of our follow-up. But when we start looking at kind of digging into the weeds, understanding these numbers, a lot of these previous health scares or epidemics that we had before, they tended to kind of peak out around mid to late March, early April. And then with the cases starting to go into decline, primarily because as we hit warmer weather, this seems to be something that subsides with warmer weather. So that seems to be conventional wisdom, that this is going to get better as we get into a warmer climate. Again, but nobody really knows. We are speculating at this point. We're just trying to use this as a hopefully calming to you, is that we are long-term investors. We are not traders. You don't want Jared and I sitting around our office guessing as to where we think this is going to go and move your money and manage your money accordingly. We have to use long-term investment discipline and a long-term investment philosophy to make sure we're helping you achieve your long-term goals. And if we are sitting around reacting to every little story, everything that can make us nervous or fearful, we wouldn't be doing our job. Our job is to be that calm, to be a good steward when there's a storm going on, to be calm, to be that, that shoulder to lean on when you have questions. That's why we're doing this. We want to make sure we're here and we empathize. This is not, we watch the news, we read the paper, even though I've told many of you stop watching the news. I think with this going on, you can't stop. But this too will pass. And again, we just want to be here to help provide some guidance. And I'm rambling right now. So Let me move on to a couple other slides here, and then I want to make sure we have plenty of time for Q&A. So this was an interesting slide that was put together by BlackRock. And so what this actually shows is that back-to-back down 3% trading days. So we actually had 2 really big down days in the markets, and that doesn't happen often. And so we had these back-to-back negative 3% down days for the markets. And so when looking back, I think the data goes back to 1980. Let's see, there are, how many options do we have on this? It looks like there are about 8 times where this has happened. I can see that, okay, that's fine. Yeah, you can. So, there's about 8 times where we've actually seen the volatility, this kind of volatility in the markets, and the market kind of at, the back-to-back trading days went down about 8%. And 1 year later, the markets on average rallied 25%. So if we look at history as a guide, this should kind of give you that confidence that says, you know what, we got to ride through this storm. The market volatility has already hit us. We can't now look back and say we should have made changes a few weeks ago. Honestly, we're not traders, so that wouldn't be something that we do. But if you look here at our the 1 year numbers, the markets in past, based on this past volatility, we've actually seen where your accounts are, at least on average, these the market returns would have been up about 25%.
Sure. Is that notice showing up on your side? No.
Okay. So again, this was just some information, probably to support some market volatility issues. So the other thing that says the worst calendar weeks. So the week of February 23rd was the 4th worst week in the last 70 years. So again, why we're here today is because of this volatility. So we saw the market sell off about 11.5%, and I think that's what's concerning to people is the fact that it has been so volatile. Well, when we've had periods like this, so basically they went back and looked at this research through BlackRock, looked back and said, I wanted to see the top 20 worst calendar weeks over the last 70 years. Said, okay, if I took those really, the top 20, and then said a year later, how did the market do? So those top 20 worst calendar weeks, the market's lost 9% in those top 20 worst. And the 1 year later, the recovery on average is up 18.5%. So again, kind of coming back to this idea that markets have sold off, the bad news is out there. Likely going forward, things will improve. How quickly they improve, we're not sure, but history kind of shows us to expect us to get a rebound. This is a chart that says the title is the 11-year anniversary of bull market. So this chart illustrates 4 previous bull markets, and these are fairly long bull markets. When we look at a bull market as a rising market, and we're looking at periods from, I think that's from 1946 to 1961, 1974 to 1987, 1987 to 2000, and then 2009 to 2020, so where we are now. And basically what this shows is that these 4 bull markets through this 11-year anniversary had almost the same movement. If you look here, this yellow color, this bar, this really dark yellow on the bottom, kind of shows where we are today in terms of what your account would have grown to with the hypothetical investment in the markets. And it's very similar to those previous 3 bull markets. And then if you look after kind of some of the volatility we're experiencing, these bull markets went on to reach new highs, and you can see the magnitude of which of how that actually occurred. So we talked in our economic and market outlook just a month ago about how we were expecting like this next 5 to 10 years to be a really strong time for our economy. But if you recall, I mentioned that we don't think this goes in a straight line. Our economy is always susceptible to some shocks. It seems like the government right now is trying to put things in place to create some stimulus. But if we look again, using history as our guide, because that's really all we have at this point, is historically, even though we have a bump in the road right now, that this bull market still looks like it has some legs. And so again, hopefully some of these charts are giving you a little bit of providing a little bit of credence to our story. And let's see here. All right, Jared, you want to tackle this one?
Yeah, so what this chart shows is going back to March 9th of 2009, the total return in the S&P 500 is basically 453%. So over that basically 10 year period or so, there was 5 times where the market was down between 10 and 20%. I can kind of go through basically the average decline is 15.9%. the duration of the decline was 84 days, and the duration of the recovery was 103 days. Now, you can look and see the different periods, how some of the data will be a little bit different, but kind of the current decline was 18.4%, duration of decline 15 days. So obviously over a really short period of time, and duration of the recovery is unknown at this point.
Yeah, and just think of that. So if you can see that on your chart, the previous average time for the market's decline was 84 trading days, which I'm assuming that's, if you take an average of what, 20 some days, 22 days in a month in trading days. So that's 4 months that would normally occur. And this occurred 15 days, which is 3 weeks.
Yeah.
Which is why it's so shocking.
Yeah, and even over that time frame, even though over that 10-year period with these periods where the market lost, 19.78% or 15%, the market average has averaged an annualized return of 16.8% since March 9th of 2009, basically when the market bottomed.
Yeah, and the one thing that's kind of an old adage is, as an investor, we feel like we're taking the stairs up, which means you look at your account, feel like you're taking the stairs up. So you make progress slowly, one step at a time. And when we have a market sell-off, it feels like you're taking the elevator down, which means that it took a long time to build up these gains and then they get wiped out pretty quickly. But if you look at the long term, we're still heading in the right direction. So we don't want these short-term periods of volatility miss the whole point, that even though there has been a tremendous amount of volatility the last 11 years, that directionally the market has been way up, and then average annualized return has been quite strong. And so that's just the message we're looking at. And I think, we always want to look into the future and say, what do we think is going to happen? And we don't have a crystal ball there, but we do want to. I think we might have. I don't know if we have any more slides. I have some other slides that we might go through. One of the things before we jump into questions, we can't give you advice on should you refinance, but one of the things that interest rates have come down so much. A few things that are really mind-blowing is that the 10-year treasury, which I started in this business back in 1997, so right out of college, and the 10-year treasury, so the 10-year government bond was yielding around 6%, so a little bit over 6%. As of today, it's around 0.5%. So that basically means on a safe 10-year secured investment, it was at 6.5, it's now at 0.5. Additionally, the 30-year treasury, which I remember meeting with a client who had a bond that was issued back in the mid 80s, it was paying 16% per year on a 30-year government bond. Those bonds today, those don't exist essentially today, but the 30-year treasury went below 1% for the first time in history. So these are historic lows. So what's the good part of this equation? Well, those of you who have debt, whether it's student loan debt, auto debt, mortgage debt, any of those, if you have the opportunity, go talk to a mortgage specialist or lending specialist and take a look and see if you can get better terms on your loans. Be careful, there are costs associated with that. Just make sure you fully understand it. You can also engage us in the process. We can't give you the direct advice on that, but if you want us to look at if the rates are competitive, we're happy to do that for you as a resource. And so the one thing that's been interesting with the weakness in the markets is our bond accounts have done quite well. And as interest rates have come down, it's giving some people an opportunity to refinance, which, that should be good for the economy, because if everyone collectively refinances and drops their mortgage payments by $100 a month or $150 a month, that's money that's now freed up to spend or to save. So we think there's definitely a byproduct of that. And then the other thing that we've also noticed is that oil prices have been dropping. That's also kind of almost like a tax break for consumers, because now when they go to the pump, maybe not here in California because we have high taxes, on our gas tax, but we are going to get some relief at the pump, and that's more money in consumers' pockets. And so I don't know if you have anything else to add, and then we can definitely jump into some questions.
Yeah, I mean, with the oil, it's a kind of a trickle effect. So businesses, there's a lot of things that manufacturing and other items that need oil or natural gas to make the product, and then that kind of trickles down to the consumer. So it won't be overnight, just like the gas prices. We haven't seen them come down yet in California, but I think there's some small wins with some of the recent volatility that the consumer will benefit from. But obviously, everyone's looking at their accounts. Hopefully not every day, but we understand And it may not offset it dollar for dollar, but there will be some relief.
Yeah, and so just know we're going to continue to be available to answer questions individually if you have specific questions on your own situation. But we're here to help. This is when you need us the most, and so hopefully that overview was helpful. But we're going to go to Tara right now and see if anyone's raising their hands, and we'll do our best to see how. We don't want to unmute everyone so we can hear all of you. We're going to try to selectively do this, and so.
Yeah, so if you're on a conference line, you can do the *9, and you can, that'll basically raise your hand, and then until we call on you, it'll stay raised. So we'll kind of know who pressed the button or who is trying to ask a question.
We do not have any questions yet, so we can continue to ramble more if you want. Let me see here. We're gonna just stick around, see if there's any questions. I'm gonna see if there's any slides that I want to go through. A lot of these get really technical, so I don't think I want to go through that. One question we have been we've been getting asked is, is this a good time to put money to work? So the question that Jared and I always ask when someone poses that to us is, what's the purpose of the money? What's the time frame? And so, we still share the belief that if you're going to need this money to be spent in the next few years, it's not a great idea to take that kind of market risk because we just don't know when this thing is going to bottom out. But for money that really has a 5-year plus time horizon, we think there are some really good opportunities to put cash to work. Part of what we're going to be doing internally, and this is individually for all of our clients, so I can't get into the weeds too much, but part of the volatility allows us to focus on rebalancing accounts. And so when we have target allocations with a certain amount of bonds, a certain amount of stocks, and that gets out of alignment, it's up to us to get that back into alignment, which means at some point, whether it's this week, next week, or the week after, we're going to be looking for opportunities and putting some money to work, which means we might be buying some stocks at these lower levels. And when I say we might, we're likely going to be. Again, I just can't give you individual recommendations today, but stay tuned. You'll be getting confirmations from us. We're going to try to over communicate this through this time so that you really have a better understanding of what we're doing. And we also want you to be comfortable. And so for those that have been calling, we've had a lot of clients who've been actually sending more money in because they're looking at this as a good buying opportunity, and we think that's a good mentality to have. But if things have changed and you might need access to more cash than we initially thought, or you have some upcoming expenses that were unexpected and not planned for, let us know, because we want to be ahead of that and make sure that we're helping you make good decisions. And then for those of you that are taking money out of your accounts, we're not selling your stocks at this time. So if you need money in your account, we're using cash that's in there. And if we actually run out of cash, then we're going to go look at some of our bond mutual funds to actually liquidate from there. So we're not taking from your stock allocation. We're not selling at this time, but those of you who are spending, we do need to get cash from somewhere, and we're taking it from the fixed income side, which is the side that's actually done quite well through the sell-off. No questions. Well, I don't know if you're intimidated by our new format, or if we just did such an amazing job. I don't know what, or maybe some other reason, but I don't know if you have any final words, Jared.
I think getting back to what John had said with clients calling in and saying, should we be doing anything at this point? I think my first question usually is, have your cash needs changed? So that is something to keep in mind is, if there's something that's coming up that maybe we don't know about, like a new car purchase or planning for a wedding or something like that, we want to know that information so we can essentially plan for it as the market does recover. We can have those notes in place so we start taking profits and kind of moving that money into more fixed assets to essentially get your allocation in line with your future spending. So usually the first question is, has anything changed on your end? And if the answer is no, then we have essentially planned for this volatility and can ride it out and spend from fixed income if needed for the clients that are spending from their account.
Okay, well, that's it. This is version 1 of our webinar at Vance Wealth. So let us know what you think. So if you were on this call, we did make some notes. If this was valuable, let us know. We do want your feedback because we want to hopefully try to improve these. If you had some questions and maybe you weren't able to get through, or you wanted us to maybe prepare ahead of time, that's something that we can entertain. But all of us here at Vance Wealth, we care about We care about you. We know this is this can be an emotional time for some of you. So if there's anything we can do to alleviate some of that stress or just make you realize that we're taking care of things, we're on top of this, we're here to help. And I would just welcome you to reach out. So thank you and have a great afternoon. Thanks, everyone.